This is FinTech Insider News. This week, Revolut is going head-to-head with American Express. Stitch's CEO is here to tell us about their latest fundraise. And 60% of Coachella attendees use Buy Now, Pay Later to pay for their tickets. We'll be discussing all of this and more on today's show, so don't go anywhere.
Hey, Fidelity. What's it cost to invest with the Fidelity app?
Start with as little as $1 with no account fees or trade commissions on U.S. stocks and ETFs.
That's music to my ears.
I can only talk.
Investing involves risk, including risk of loss. Zero account fees apply to retail brokerage accounts only. Sell order assessment fee not included. A limited number of ETFs are subject to a transaction-based service fee of $100. See full list at fidelity.com/commissions. Fidelity Brokerage Services, LLC, member NYSE SIPC.
As a contractor, I don't pay for materials I don't use. So why would I pay for stuff I don't need in my mobile plan? That's why the new MyBiz plan from Verizon Business is so perfect. Now I can choose exactly what I want, and I only pay for what I need.
Right now, with MyBiz plan, get our best price, as low as $25 a line. Visit verizon.com/business to get started today. Price per month with 5+ lines. Includes autopay and paper-free billing and special intro offer discounts. Taxes, fees, economic adjustment charge, and terms apply. Offers end June 10th, 2025.
Hello and welcome to episode 955 of FinTech Insider. This episode is coming to you on Easter Monday, so if you celebrate, happy Easter. We hope you've been treated to plenty of chocolate eggs. As always, I'm not alone. Today, I'm joined by a cracking panel of experts to help us unwrap the biggest FinTech stories from the past 7 days. First up, on this week's pod, we have a welcome return for a FinTech Insider OG, Sam Moll, Head of Business Development at Move. Welcome back to the show. How are things with you, Sam?
It is going well. And this is Laura Watkins, one of the top 30 most influential fintech marketers. I saw that on LinkedIn. Let's go.
Thank you very much. Thank you.
That is awesome. Fintech royalty, everybody.
And right back at you. Next up, we have another FinTech Insider return for Kian Pillay, CEO and co-founder of Stitch Money. Great to have you with us. You have some exciting news, which we're going to get to later in the show, and we have already hinted at in the intro. But for now, please tell us a little bit about yourself and Stitch.
Hey, thanks so much for having me again. Always fun. Stitch is an enterprise PSP based in South Africa. We essentially help local enterprises or international businesses entering South Africa move money.
Fantastic. Well, thank you for joining us, and we're going to dig far deeper into all of that very, very soon. Last but not least, a warm welcome back to the podcast for Veronica Glab, independent fintech consultant. It's always great to have you on the show, Veronica. What have you been working on recently?
Thanks, Laura, for having me as well. And at the moment, I'm working with a couple early stage fintechs on their go-to-market strategy in the financial wellness space. And pretty soon, I'll be headed back to London for UK FinTech Week at the end of the month and FinTech for All, which is an event hosted by the Brazil Investment Week team.
Awesome. And maybe we'll see you there. So now we have a panel. And let's start with some news. So our top story this week was Revolut to take on American Express with a move into reward credit cards. The story was on Sifted and everywhere else, including the 11FS Slack. According to the report, Revolut is currently developing a new points-based credit card, putting it head-to-head with major players like American Express in the UK rewards market. The card will use Rev Points, Revolut's own loyalty system launched last year, and will be tailored to different user tiers within its subscription model. This move is part of a broader product push by Revolut, which now offers everything from crypto and stocks to pet insurance, serving over 50 million users globally. The UK rewards credit card space is still dominated by giants like Amex and Avios, with only a few challengers like fintech Yonder attempting disruption. Veronica, I know that you love a Revolut headline, so I want to come to you first on this. What was your thoughts? It's a bold statement taking on Amex. Can they do it? What do you think?
Yeah, it is a bold statement, and I'll try to contain my excitement about all of Revolut's really cool brand partnerships. But the way I see it is that there's two sides to this. You know, on the one hand, they are absolutely a credible threat poised to really disrupt the market. You know, they're fast, they're global, and they're already offering perks that kind of mirror a lot of premium cards, you know, airport lounge access, eSIMs, you know, different lifestyle different lifestyle integrations as well. So if this were in the US, incumbent credit providers, they might not look at this too seriously yet because they've got a really strong lobby to the US regulator. But if we're looking at the UK and Europe, where customers are open to new types of products, they are a little bit less dependent on credit than American consumers already are. These consumers are open to being educated and enticed by a new program, flexible over flashy rewards. So I think this is definitely one to watch.
Okay. So building on that, if you're the CEO of Amex, you're perhaps not threatened yet. However, if you're a smaller challenger in the same space like a Yonder, should you be afraid? What do you think, Veronica?
Yeah, I mean, I think it'll be really interesting to see because I could see this going multiple ways. Yonder certainly has first mover advantage in that space, but Revolut at the
Mm-hmm.
same time is known for making really fast and really clever brand partnerships, from ClassPass to NordVPN to telecoms integrations that already really put it at an advantageous spot. They've got the tech stack, they've got the infrastructure. So really what they'll need to do is just focus on the user acquisition. Again, I think in the UK, that could really disrupt the space where Yonder is already active. But in Europe, we'll have to see. The European Commission has recently made some statements on moving away from some of the payments rails like Visa and MasterCard. So if Revolut has some serious ambitions to move into the European market, I think in the medium term, they'll probably need to look at optionality for different types of payments rails and infrastructure.
Mm-hmm. And Sam, coming to you. In the US, obviously, the credit cards rewards market is hugely ingrained in customer behavior already, probably more so than the UK. What do you think about Revolut's entry into this from that US perspective? And do you think they will attempt to replicate this in the US?
Man, that's a good question. US is weird. Lord, we're weird. I think Amex, if memory serves me right, you got about 100 million cardholders in the US. It's ridiculous. I mean, Amex just has a massive foothold here. We are addicted to cards. I think y'all know that. Man, we love a credit card over here. And we love points. I think I read a stat this morning, something like 70% of US cardholders use some sort of a point scheme in their buying decisions. You go to any U.S. conference, I mean, Veronica, I know you know this, the points guy, Brian Kelly, all 7'2" of him, is always on stage, and it's always packed out. So using cards for points, that's the main driver. If you walk down most streets in the U.S. and you ask somebody who Revolut was, they're going to have no clue. That's the U.S., you know? For the U.K., I think this is awesome, by the way. I'm with Veronica. I absolutely love Revolut. So I think for the UK market, fantastic. In the US, it wouldn't even be a blip. Sorry.
That's fair. Kian, what was your take on this? What's the sort of point of view from the South Africa market that you've seen? Can anywhere beat the US for that kind of rewards points-based loyalty obsession that Sam was talking about? Can that behavior even be taught to a market that doesn't have it already at this stage in the UK?
Yeah, it's a great question. I saw the topic in the pre-read, and I was like, oh, that's interesting. Like loyalty and rewards are just so not a thing, right? In South Africa and most African markets. From like a banking perspective, credit cards, banks, etc. Like, many markets have very low card penetration in general. South Africa is actually decent, but very low credit card penetration in South Africa. A lot of debit cards. And like loyalty and rewards are really big, but at like retailers, right? Grocery stores, clothing stores, and stuff like that. Almost nothing from financial institutes. And so I think there's actually a big opportunity in some of these markets where this hasn't been done. I would say maybe if people come into these markets and they're really sharp about what are the incumbent payment methods and how to do rewards there, right? Like cards in some markets, sure. But if you go to like East Africa, you go to Kenya, like how would you do rewards on like M-Pesa, right? Where like majority of transactions are done. So I think it's really interesting, right? Like I'm a big Revolut fan. Revolut is expanding into South Africa, supposedly by 1,000 rumored articles on LinkedIn. I think it could be really interesting to kind of see like what rewards and stuff look like from them, from like a newer player. But historically, it just hasn't been done here. So I think like you would have a captive audience, but it just hasn't been tapped into.
I will give you a great example and another good reason to live in South Africa. In the US, if you fly domestically, unlike American Airlines, United Airlines, you know when you're about 30 minutes from landing because the airline stewardess will get on and do the credit card pitch for whoever they're partnered with. Whether it's to see Veronica's laughing, whether it's, you know what I mean? You know you're about to land because now they're doing the credit card commercial on every damn flight. So it's a given. That's why I love flying overseas. It never happens. Usually wake me up when I land.
Veronica, what's your take on the idea of sort of building a behavior that doesn't exist in a market? For example, like Kian was talking about, like rewards don't exist in South Africa. They do exist a bit in the UK, but we're not as sort of married to them as the US. How do you create that behavior if you're a Revolut entering this market?
Yeah, I mean, look, I think marketing is going to have to be very specific to each particular market where they hope to expand. And that marketing is going to have to be aggressive. I say this as an avid Revolut user. Like I do have the Ultra prescription or subscription.
It's not quite medical yet.
Freudian slip, a total Freudian slip there. But I'm a Revolut Ultra user, and I already amortize that membership on my overpriced Pilates classes, on eSIMs whenever I travel, airport lounge access, like FT subscriptions. Like I really, really do use it, and obviously clearly evangelize for it. And then I'm always surprised to find out when other Revolut users don't really know about these particular products, which you really do get a lot of bang for your buck on that subscription. So part of it is marketing and just building that awareness as well. But where Revolut got even me as a user hooked was because they've gamified that interface. That it's if you unlock this feature, you get this many rev points, which you can then cash in and use it for a discount on an eSIM or buy yourself a lounge pass in an airport. So when they've gamified it like that with this point system, this is what already incentivizes those kind of addictive behaviors or repeat behaviors. I think they've done it really, really, really well. So as long as they attack it from those two fronts of, having very, very specific marketing that doesn't just transcribe, but really creates the messaging for each culture and community they're trying to tap into. And then they keep developing the gamified platform. I think they've got a few good ingredients going.
Definitely. And that's going to be so important, both of your points there, and equally your earlier point around making sure they actually offer things that people want as a reward. I think they did get maybe a little bit of friendly bantering when they announced, they had a partnership with like Tinder Gold as one of their rewards and things like that. And people were like, oh, is that appropriate? Is that what I want from my from my famous provider? But, I would assume they'd done some research to make a decision that was the partnership to go down.
Yeah, I mean, you have to give them credit for being really innovative, right? Those brand partnerships are very purposeful. It's the subscription to the FT, which is a very, very good publication with a very good reputation. It's the integration with NordVPN, for instance. So if anyone wants to stream White Lotus, they know their audience. They really, really do.
Absolutely. So what do we think? We're kind of coming to the end on this one. Do we think this is going to be like a success? And, Revolut being Revolut, they churn things out at a rate of knots, almost to the point that, to your point, Veronica, not all of their customers actually know everything that they offer. So how are they going to make this stand out? Do we think they can do it? Obviously, they're up against stiff competition from Amex, but to your point, if they understand exactly who their customers want, as opposed to Amex's, they can, really make a dent on this market. Maybe as a sort of quick fire, Kian, do you think they can do this in the UK, and therefore, do you think they can take this wider?
Yeah, pure outsider bias. I've just been very impressed by how Revolut have executed on everything, which, like I'm an outsider, so I hear nothing about Amex ever, right? So I don't actually understand how entrenched and incumbent it is. So net, if I looked at sort of the title, I was like, yes, this is interesting. This is compelling. Their user base seems like they'd be captive for this sort of thing. I won't pretend
100%.
to understand how entrenched Amex is, but I get a sense of it. I would say it's a credible threat.
Yes, particularly in this market, I would say, especially to their own
Correct.
audience. Sam, obviously, you talked about how Amex is sort of so ingrained in the sort of American psyche, but do you think they can break that over here?
100%. And then reason for that, and I think, everyone's kind of alluded to this, it's the Revolut brand. I mean, there's brand equity there. It's known, like that's why in the US, I said they wouldn't do a blip here. In the UK, heck yeah. I mean, incredibly well known, respected. That's what 70-80% of this is actually knowing the brand and having that trust there. So yeah, I would not bet against Revolut in the UK market.
Fantastic. Well, I think that is the best place to end this story on, but we actually recorded an interview with Revolut's UK CEO, Francesca Carlesi, this morning. So keep an eye out for that on our feeds when the episode drops, and we'll be asking her about all of this and more. But I'm going to move us to our next story, which is that Stitch secures $55 million in a new funding round. Story in the papers and many other places. South African fintech Stitch has just raised $55 million to expand and optimize its unified payments platform across the country. This latest funding builds on a previous $46 million VC round and a $25 million Series A extension last year, showing growing investor confidence in Stitch's ability to shape South Africa's financial future. Stitch offers businesses a way to integrate various payment methods, both online and offline, through a single unified system. And with its recent acquisition of ExiPay, Stitch is doubling down on omnichannel payments, aiming to bridge the gap between digital and physical commerce across the continent. But don't take my word for it. We have the perfect person on the panel to tell us more about this. Kian, firstly, huge congratulations on the raise. What can you tell us about it and what this means for Stitch's ongoing journey?
Thank you so much. That was a very kind and comprehensive intro. I think we've had a very interesting journey, and we've oscillated a lot from what our core focus is. We started in South Africa, and we were like a Plaid for Africa, right? We were an open banking player that largely no one would pay for. We moved into like open banking payments, and we started to get some fit there. Weirdly, we started to get most of our fit from enterprises, and I think it was which is very non-obvious for us. We thought startups and developers and the usual suspects would be who would take us. And I think the reason was we were just built very modular. We were newer, and we could just be a little bit more flexible on all the weird, horrible things that only fintech people care about: settlements, recon, which bank, T+1, T+2. And actually, like, enterprises care about that a lot, right? They have, entire teams just working on, CSVs and markup files and recons and stuff like that. So we had good fit there, became a full suite PSP. And I would actually say largely that was the thesis and the narrative for our last round that Ribbit led. Somewhere in between there, we said, hey, we want to be this Pan-African PSP, and that largely didn't work out, and I'm happy to talk about that later too. I think once we started to find the fit with enterprises, we realized actually if we went really deep in a single market and we served the majority of payments flows in this market, it could be really compelling. It could still be venture compelling, even though we said South Africa, not Africa, right? And we started to get very good online fit there, and that was, the premise of our last round. I think built up enough brand equity with some of these businesses that they started to say, hey, could you do in-person payments for us, right? And South Africa has not quite had the full-on digital, adoption online yet. In-person payments are still about 90 to 95% of all volume in South Africa, right? Online's growing super fast, and it will get to the point where it looks like the UK or the US or anything like that, but it's just not there yet. And And so we were fortunate last year to acquire a business called ExyPay, which was doing in-person payments for large enterprises in South Africa. And it was like a very natural, this could be what the quote unquote IDN of South Africa looks like, right? It's omni-channel. We're doing online for enterprise, in-person for enterprise. We can really start going where the meaningful volume is for these enterprises. And that's sort of why we look to raise this round now. We could really double down on how deep we go in South Africa, but do it like in a slightly less superficial way to just online payments. We could do the offline payments as well, and we're starting to move into acquiring, so we won't need a bank to do that as well. And so just to get a little bit deeper in those enterprises stack.
Amazing. Well, huge congrats on how far you've come, and equally on your on how candid you're being about the journey and the kind of changing of direction along the way. If you're happy to, can you tell us more about that as to why you decided to go South Africa rather than Africa for the immediate future, let's say?
Yeah, I'm happy to. I think the decision was not because we were clever; it's because we tried to go Africa and we failed. So there was a moment in time where I think Africa got a ton of attention, venture attention. It was like the final frontier, and 2021 was 2021. And so like double, it was the final frontier plus 2021 was a thing. And everyone was kind of like, I bet there'll be a few Pan-African business that like really do this fintech thing, right? And it's like whether you're a PSP or whether you're, an app or you're consumer facing, whatever the case is. And to be honest, we believed it too, right? We thought we could be at the time Plaid for Africa, which is really funny now because we weren't even Plaid for South Africa, right? We didn't even get the first piece working, and they were like, no, we'll just do this in all markets and this will work. I think it's just like each African market is so fundamentally different, right? Mm-hmm. The level of financial inclusion, the payment method people use, the regulation, the banks. Like we had all these stories and our own narrative where we're like, there are these 3 banks that are in like 17 African markets. We could partner with them and we'll just have access to them. And like largely you find out all of these things are untrue, and compliance and regulation and even just like the banks in each market work differently. Like if you work with one bank that is in 17 African markets, you're working with them in one market, right? And if you go do the same thing again. So I'm not saying it can't be done, but the order of complexity is just absurd. I think you have to be like a very, very large business, and I think you need to invest tens of millions of dollars into each market you want to expand into, right? Like we were a seed Series A stage company. We barely had traction in our home market. I think we were very fortunate that at the same time we were absolutely screwing up expanding to Nigeria. We were starting to get a bit of traction in South Africa for payments. And we were sort of like, hey, let's just focus on this thing. It was as 2022 was sort of happening. So venture was sort of drying up. We were fortunate we just raised a round. And we sort of just started to compound in South Africa. Now, like looking back, I have a lot of opinions on why it was silly we did what we did. But I think like a lot of happy accidents that we ended up just getting traction in South Africa, to be honest. And now it's sort of working decently.
Awesome. And hindsight is always 2020 anyway, isn't it? So.
Totally.
As Sam, you were kind of nodding along as Kian was speaking there. What's your thoughts on this?
Well, for our American audience, Africa's a continent.
Correct. It's not a country.
It's a country. You are confusing so many people through that entire conversation. Let me just help you out. I think it's fascinating because, I mean, here in the U.S., I'm working for a company called Move, where it's the same type of, to a degree, same type of thing, right? How do you actually take every modality of payments and address it? And God, I feel your pain. Right? 4 years in, 100 million plus invested and still building. It's hard. The question I have for you is on the regulatory side, because, jokingly in this podcast, we talk about the US from a regulatory standpoint all the time. I am not familiar with South Africa from a regulatory standpoint. Is it the living hell that it is in the US, or is it a little bit, how is it shaped over there?
There's pockets of living hell. And
So Dante's different levels. Okay,
correct,
that's cool.
correct.
Yeah.
There's levels to the Inferno. I would say there's a lot of incumbent things that
Makes sense.
work well, that have decent scale for banks, for fintechs, and that's kind of like well understood and well regulated. The way banks partner with fintechs, what fintechs can or can't do, etc. That's fine, and you can sort of move. I would say there's a lot of politics around that. You can't just be a fintech and start working with a bank and you fill out a form and that's how it works. You need to know a person and you need to have enough credibility, and one of your investors has to, play golf with one of the people at the bank, and it's like all of this nonsense. I would say it really struggles to keep up with the pace that the world is moving at, right? Like real-time payments are suddenly becoming a thing all over the world. And like suddenly that's, okay, what's that? How do we do that? How do we engage with this? How do, PSPs work? How do banks work? How do you start including PSPs into like more historically bank-led functions, acquiring, settlement, etc.? That's slow and that's hard. Like it's happening, but it happens in 5 and 10-year increments. It doesn't happen faster than that. So yeah, bits and bobs. I don't think like they shut people out, but just not everything is accessible.
Veronica, to bring you in, obviously with your experience in sort of VC, investor relations and partnerships, what was your kind of thought on this and the sort of wisdom in being local first?
Yeah, Laura, thanks for that. It's exactly what I was thinking as well. Kian, I think your team are such a great example of responding to, something in your market and making a strategic pivot. I talk to VCs all the time when I do deep dives on the investment landscape in all different markets. And I think being able to see an external stimulus that says, hey, we need to do something a little bit different in order to scale successfully, or instead of trying to be this sort of jack of all trades for everyone, let's do one thing really, really well, or one market really, really well. I think that's such a smart move. I think that sets you up for really being able to scale the business long term. So, cheers to you on that, genuinely. But even more so, I think on your omni-channel strategy as well, I think that was a really clever and strategic move on your side. And you know this much better than I do, but when you're able to unite, especially in very particular markets where cash is king and infrastructure can be all sorts of patchy, if you're able to bring together the online and offline payments smoothly, that can make such a massive difference to consumers, to small business. And at the end of the day, that is really, that's a really, really impactful and scalable model. So genuinely, congratulations.
Awesome. Thank you. That's very kind.
Maybe just to give us a note to end on, Kian, could you maybe just double down a little bit more on that kind of the necessity of joining together the online and offline payments for the good of customers in that market, kind of make that real for us just to finish on?
Yeah. I think it was also a non-obvious thing for me for a while, because I was like, what is omni-channel? And I think increasingly, like I actually find it interesting from the lens that, like, again, most of our volume is happening in person. There still is a lot of stigma. Well, not stigma is the wrong word, but the adoption of e-commerce isn't giant, right? Like we work with one of the largest e-com providers in South Africa, and the anecdote that they always use is they randomly added a store locator in their app, and they thought, just that's a thing that you do. They have 3,000 stores throughout South Africa. They started as a retail business, and they found that was like the most viewed page on their app. Why? People would browse for 5 minutes and be like, these are the shoes I want. This is the t-shirt I want. Okay, where's the store I can go and physically buy it? And so actually, and we work with that business in person and we work with them online. Actually, I think a lot of the adoption is coming with people going in store and they're like, hey, I'm trying to buy a pair of size 9 shoes. They don't have them. Okay, here, now we can do an omni-channel thing for you. We can scan it and we can deliver it to your door, right? That's technically an online transaction that you started in person. And we found with this business alone, just on the small subset of customers that they're using, that they're 5x more valuable to this business. One, because they shop more often, and two, it's more value because now they have complete comfort. I can buy online, I can return in person, I can go in person, I can buy things that I don't find here online. I think it just really opens it up to the way that the market is working. And I think previously these have been very fragmented sort of worlds, and you're like an e-commerce person or you're an in-person person, right? And that's obviously not the way most of the world has moved already, and South Africa's lagging behind there. And so I think increasingly, if we can combine them, there's just like a huge opportunity to one, just accelerate pure online digital adoption, but two, like the merge between them. So I think very nascent, and I do think it will take us a long time before that gets like serious scale, but it's like super compelling. I think that's yeah, I can't see a world in which the market doesn't go there. Maybe we are not the only driver of that, but I do believe that that's the way the market is going.
Amazing.
Funny enough, still in the U.S., I mean, I'm going to say this, and then Veronica, correct me if I'm wrong. Somebody have this stat wrong. I think retail sales in the U.S. are still 80% in store. Still roughly around 80%. So, we talk about the impact Amazon has had and the shift onto, away from in person, but point of sale, devices, and then all of that. It's still 80% of the U.S. market, and we're the big one, at least for another week until God knows what tariff is. While we're live, it just went up to 245% tariff increase in China.
Oh my goodness!
There you go, everybody. 245%.
Okay, so what we're saying is Kian has his work cut out for him, but it's definitely a really important mission, and we, massively congratulate you on the raise, and we look forward to hearing about what you do next. And please do come back and tell us more about it. But on that note, we're just going to take a quick pause here. Back very shortly. Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.
This episode is brought to you by the Toyota Grand Highlander. From daily routines to life-changing adventures, the Toyota Grand Highlander is spacious, powerful, and ready to take on life's grand challenges. Advanced safety features and innovative technology give you confidence for whatever life throws at you. And it's available in a hybrid Nightshade Special Edition, which includes sophisticated gloss black exterior accents and 20-inch black alloy wheels. Learn more at toyota.com/Grand Highlander. Toyota, let's go places.
Welcome back. Before we dive back into the news, I wanted to tell you about our latest Insight show, where we take a deep dive into the world of funding and what the current landscape actually looks like for fintech founders and funders. It's out now. Just head to the episode right below this one. Very pertinent to today's discussion as well. Now back to the news, and our next story is Wise are making big tech moves in India. This story was in the FinTech Times. Wise has announced a full stack hub in Hyderabad, as well as an international account details feature, which will enable Indian freelancers and businesses to get paid from abroad in 8 global currencies. Set to open in the second half of 2025, Hyderabad will become Wise's newest full stack hub, with plans to hire hundreds of employees in the coming years across product and engineering and operations. Wise's APAC head of engineering, Smriti Ravi, will relocate back to India to lead the build of the underlying infrastructure, including direct connections to local payment schemes in Singapore, Australia, and the Philippines. India has been integral to Wise's growth since 2013, when Wise first started powering payments for India's diaspora. Today, about 10% of all the money sent from abroad to India is done so on Wise. So maybe let's start with you, Sam. Is this a smart move from Wise? Were you surprised? Perhaps you weren't, but I was. That the stat that 10% of all money sent from abroad to India is moved through Wise. Are they kind of just doubling down on what is working for them?
Now, India's they got the highest amount of cross-border money movements in the world. They lead it, something like $120 billion in remittances. So, no, I'm not surprised at all. And I love Wise. I mean, we talked about Revolut and the brand there. Wise, same thing, man. They just move after move after move is incredible. So I think this shift, or this strategy approach going into India, I think it's brilliant. I think definitely, taking somebody that knows the market and having them lead it is. Who would think that's a brilliant move, right? Actually, take somebody who actually knows the market and say, it's all yours. We don't do that over here. I think it's brilliant. So again, brilliant move.
Definitely. And you mentioned sort of remittances. They got an upgraded remittances license in August last year, which is potentially driving some of this. The RBI granted Wise an authorized dealer 2 license, which allows customers to increase the amount of money that can be sent from $5,000 per transaction all the way up to $250,000 in a single year.
Let me tell you one challenge they're going to have from previous experience. And I know they're going to address it, but I don't know if y'all remember the story from a few years back, but MasterCard was actually banned from issuing any new cards in the Indian market because they weren't able to pass an audit to show that data didn't reside outside of India for more than 24 hours. So they went through almost a year and a half where they were completely banned from issuing any cards. Can you imagine in that market? And so, trust me, companies like Visa were high-fiving each other. Do you know what the actual solution was for everybody? This is really incredible. They built data centers. That was the cheap way to fix this, was to build old school server data centers and launch them in market. So,
those data centers are probably still there, right?
Oh, they're there. 100%. They're there. But data sovereignty is a key. Is a key component of any of these international strategies, and it's only growing. So, that data residing in country for all of your fraud monitoring, for everything that you're doing is huge. So that is something you have to take into account. I know Wise has, but, it's becoming more and more the norm globally.
That's fascinating because, so the remittance space in India has always been dominated by the big banks, probably for the reasons you just said, because they can house all that data and keep it on site. But yeah, could this legitimately, if they get it right to the points you just raised, increase their market share and competition in this market? Can, sort of same deal as Revolut, can they take on and be a genuine challenger in this market?
I think that tech stack at Wise has is unbelievably good, and I'm not going to act like I know what the tech stack is for the top banks in India, but I'm going to take a guess that it doesn't compare.
Fair. Veronica, what's your thoughts? They're launching a new account feature, largely because there's a lot of research that showed a lot of challenges for businesses trying to receive money from abroad was largely to do with transaction fees, non-transparent pricing, all of things that are sort of built into Wise's DNA to fix. And there's sort of 1.9 million people in the market who are working for foreign companies, which is only expected to rise. So are they addressing a real kind of need in the market they're serving here?
Yeah, they definitely are. I mean, you can also see that through their integration with the payment schemes in Australia, Singapore, Philippines as well, right? That was a very pointed and strategic move on their part. So I think it's a really great move overall because it's not just doubling down on a really large market they have, but this also comes on top of the very top-down approach from the central government in India, which wants to move the country away from dependence on cash. So that means smoother remittances for individual end-to-end users, but for small businesses, for the freelance and gig workers, or even salaried workers that work for those businesses as well. I think this is a much bigger picture of the digital transformation of the Indian financial services system overall.
Absolutely. And Kian, given what you do at Stitch, what's your thoughts on this sort of infrastructure play, being able to build it, own it, tap into those international markets that Veronica mentioned, Singapore, Philippines, etc.? What's your take?
This is what we term the Stitch approach, but it's probably not. It's probably many, many, many people before this. We've got to the point now where we think it's almost impossible to build something of really high quality unless you do it kind of yourself. That's exceptionally reductive. But when you're doing payments at scale, it's really tricky to not own the rail. It's really tricky to rely on a payments provider who relies on a bank. And all's well and good when things are working. But the second there's an issue, everybody's pointing fingers at everybody. It takes you days to resolve it. And we've started doing things this way, right? We started and we had an existing provider was our card provider, and we basically white labeled them to start. And that really, really didn't work. And the way that we went to market was people white labeled us to do pay by bank. And I would say that really didn't work in both directions too. Now, largely our strategy is to just build directly, and Wise is at significantly larger scale than us. I think it makes a lot of sense. I think you really get full control and you start to be much more competitive with incumbents, with banks, etc. For markets that they have scale, which India is definitely one, I think it makes a ton of sense.
Absolutely. And kind of Veronica, doubling down on that point, sort of obviously owning their own tech stack, owning their own sort of rails and infrastructure and so on. Will that negate the need for sort of partnerships in future, or will it just change the nature of the partnerships that they make in these markets?
Yeah, I think it's more the latter. I don't think we can entirely negate it, but it does give them a lot of new opportunities to pursue partnerships, not out of a necessity, but out of maybe a desire to disrupt a certain type of product or service that they want to offer to their end users.
Okay, so kind of as Kian was saying, not having to use this payments provider that connects to this thing, and if it all doesn't go to plan, you're relying on somebody else to fix it for you. It's more out of choice.
Exactly. I think this gives them the room to push the envelope on what their offering really is.
Sam, you're looking pensive. What's your thoughts? How are you going to build on that?
No, I mean, I agree. I just keep constantly coming back to this incredible solution that you're building in South Africa and the focus of it. Right? Probably the best word of advice I ever heard was one of the founders of Braintree, which is Venmo, everybody. Because his name's Mike Dudas, and he was at Google at the time. And I said, what's your one piece of advice now that you've done this a few times for fintech founders? And he said, think very narrow and think very deep. Don't solve everything. Go incredibly narrow and deep. And the one problem that I have with that, I agree with it wholeheartedly, is the deeper you go, the more you realize how narrow it isn't. I mean, there's just layers upon layers upon layers of this nonsense when it comes to payments, when it comes to banking. And it makes it incredibly hard. The more you look under the bonnet, that was just for you, Laura. The more you look under the hood, the harder, the uglier this gets, and the Frankenstein system that we've built globally. You see it. So, sounds really cool, narrow and deep. Good luck.
Okay. Well, let's see what happens next. But obviously, Wise are obviously onto a good thing in India from the very start. So they probably have a head start on that. They've drilled deep already, hopefully. But yeah, let's see what they do next. I'm going to move us on to our next story, which is that Tapcheck raises $225 million in equity and debt funding to redefine payday for America's workforce. A story in fintech finance. Founded in 2019 by entrepreneurial husband and wife team Ron and Kaylin Garver, Tapcheck is an earned wage access platform set up to ease the difficulties caused by traditional pay cycles. The company enables workers to access their earned wages seamlessly before payday, easing the paycheck-to-paycheck strain and in turn improving employee morale, retention and productivity. Tapcheck's on-demand pay platform integrates with nearly 300 payroll and timekeeping systems. Provided at no cost to employers, Tapcheck allows employees to safely and responsibly access their earned wages, helping them avoid hidden fees and have greater financial flexibility. Employers using Tapcheck report over 50% improvement in employee retention, with 70% of employees noting that it reduces their financial stress. The $225 million cash injection will be used to advance their overall product development, enhance the accessibility of their MasterCard offering, and accelerate the expansion of its AI capabilities. I actually cannot believe that we've got to story 4 of the podcast without mentioning those 2 letters. So, good job, everyone. Sam, what is your thoughts on this one? Is this kind of offering a tangible solution to a real world problem, particularly in the US market, in your view?
It's definitely a real world problem. A personal opinion, it's addressing a symptom of a problem and not the problem. Meaning actually paying somebody a living wage is a massive issue in here. If you look at the majority of the people this is addressing as fast food workers, for example, it's people on the lower pay scale here who, by the way, the minimum wage in the U.S. hasn't gone up in God knows how many years. I'm sure somebody can go out to AI, or as our education secretary calls it, A1, and figure out, true story, can figure out, when was the last time we actually raised the minimum wage? We have a massive problem in the U.S. around folks living paycheck to paycheck, which, by the way, isn't just fast food workers, right? There are folks making 6 figures that are easily living paycheck to paycheck. It's a growing problem here. I mean, again, though, I like the solution that they're doing. You can see here, we talked about narrow and deep. They have to plug into over 300 payroll systems, and that's probably maybe a third of the payroll systems that exist in the U.S. So, I get it. I understand what they're trying to do. Companies like Chime and other banks, will give you your pay, I think 2 or 3 days earlier. So, there's a massive potential market for this in the U.S. But I'm going to go back to my first point. It's a symptom. It's not the actual problem.
Yeah, absolutely. I mean, just to add some stats to that, sort of 37% of Americans only 37% of Americans can cover an unexpected $500 expense. And equally, as you said, sort of Tapcheck have had particular success in the quick service restaurant sector, and they've served 112,000 McDonald's employees. And equally, as you say, they're also serving frontline caregivers, so nursing, health and rehabilitation sectors. So they're obviously going after the right people, but as you say, it's obviously, they're addressing a symptom, not necessarily the root cause, but obviously that's not their job to do. They are creating a product that's trying to address a problem.
Just to make this interesting, the number one, here we go, for those of you in the UK and in South Africa, what's the number one cause of bankruptcies in the US? Take a wild guess. Medical debt. See, over here, 66.5% of bankruptcies in the US tied to medical debt. And guess what's going to happen to every single person as the grandfather on this podcast, literally, the one old person. You're going to have medical debt. I'm sorry. It's just a fact of life that it's going to happen. And if you're lucky enough, it happens at my age and not very younger. So again, I love this solution. I get what they're doing. It is on the outer rim of addressing what the problem is.
And speaking of this as a sort of solution, Veronica, what do you think? We've already sort of touched loosely on the kind of competition in this space. Sam mentioned Chime, which has a My Pay feature that gives you $500 of your salary before payday. Monzo in this country offers payday wages from 4 p.m. the day before your salary payment. And Revolut also has an early salary feature in both the UK and the US. Is there a risk that what Tapcheck is doing becomes a feature, not a product of somebody else's organization? As this is such a big problem, to Sam's point, there's so many other players are getting in on this space.
Yeah, I mean, I do think there is that potential because a platform like that is relatively simple to build. And there's different ways that you can deliver on that, by the time that the customer gets their paycheck. So look, there's a number of international companies as well that are already doing this in the UK, in Europe, in Latin America. If they're post Series B or Series C, they could certainly be already preparing to scale to the US. So I wouldn't say it's a crowded space, but it's a maturing space because there are so many markets already around the world where there's wage inequality or just not great payroll schemes for workers. So I think it's going to be a space to watch. And where I think these guys can distinguish themselves from the market is where into their platform can they integrate or incentivize good financial behavior that encourages savings, financial wellness, financial literacy. Can they do something potentially like, I don't know if a US customer who takes early, how do we call it? Early wages, if they have to declare that differently on their taxes as well, because Americans have to declare their own taxes every year in April and do a lot of painful paperwork around it. So, those are already 4 or 5 different product integrations that you can distinguish yourself that would be potentially unique to the US market. So perhaps they've already thought of that.
Awesome, thank you. And Kian, what's your thoughts on earned wage access more broadly? The sort of payday loan market has been estimated to reach more than $46 billion by 2030. And earned wage access has been positioned as a sort of ethical alternative to those sort of more predatory practices. What are your thoughts? Do you have anything like this in the South African market?
Yeah. So, I mean, I think there was this huge wave, like both venture-backed and dodgy and all sorts of kinds of companies of like very fast scaling payday lenders in African markets in general, maybe in the last 10, 15 years. Like outrageous rates, very predatory, very popular, right? Because there are no other solutions. Same story here. People live paycheck to paycheck and, even worse in some cases. And it's often, the way that people make money is the way that they're able to still make money, and people can't afford public transport and all sorts of things. So I think that was like a really nasty trend and phase that we went down and like really encouraged the wrong behaviors. Earned wage access, we actually work with who I think is the largest earned wage access player in South Africa. And it's phenomenal to see how quickly it's growing. It's very nascent. I actually think it's one. I agree with Sam totally that it is not actually addressing the problem. It's a symptom of it, but I think it's a really compelling product. I think it's adding a lot of value to a lot of people in local markets. It has actually become, in some cases, a differentiator for very lower end kind of and more administrative jobs, right? Fungible is probably not the right word, but people jump between, quite low income jobs all the time, right? From a fast food restaurant to a fast food restaurant or call center to call center. And it's actually become a differentiator, right? Like one fast food restaurant will, offer earned wage access through this fintech. And people would rather go work there than, like for like similar fast food company because they get this product. I think it's a really compelling way for actually like the opposite to happen, not for banks to start to offer this, but for you to start offering earned wage access and start moving into more banking products like Veronica mentioned. Like how do you do saving and how do you get financial literacy up? And so I think really interesting. I think probably outsized impact in some of, the African markets too, but super early, super early.
Mm-hmm. Okay. And then Sam, finally, like in terms of the sort of future of earned wage access, at the moment, it is not officially classed as a loan. It equally doesn't create debt or any additional fees, kind of similar to credit providers. And earned wage access providers are keen to stress that it promotes financial stability and reduces reliance on debt. Do you agree, or do you think that compounds over time?
I think that's a incredibly important point. To this, and Veronica, you noted on it, right? The financial education side of this. Again, if you look at who this is targeted towards, this is lower income individuals. And as somebody who started out life as a lower income individual, I've talked about it on this podcast multiple times. If you want to see a payday lender, if you want to see a pawn shop, they're not in the neighborhood I live in now. Go outside any military base in the U.S., go outside, you know what neighborhoods these are in. And they're going to be a sub, 650 credit score. So, how do you work with these individuals to, it's more than getting them the money and in their hands. It's when they have it, how do they use it? And, how was that learned? Or does that, learned behavior come from? That's going to be a massive part of this. And, I think companies like this know that and embrace that. They're going to have to build it in. But, you can have all the good intention in the world and things can still happen. Remember when COVID struck and it was at Robinhood where the young kid was trading? And the tragedy can happen without you having the intent of that happening because your user base isn't educated.
Mm-hmm.
And I think that's a prime example of what can take place.
Absolutely. But they've just raised $225 million. So we hope that they can pipe some of that into building financial education and literacy into the platform to serve these people who very clearly need the support that this solution is providing. So we wish them luck. Okay, now for a quick look at one more newsworthy story this week that we don't have time to cover in full. And that is, many Coachella attendees are buying tickets through Buy Now, Pay Later. This story we picked up in the Payments Journal, but available in many other places as well. This weekend marked the finale of Coachella, the iconic California Desert Festival that was headlined by Green Day, Lady Gaga, Travis Scott, and Post Malone, with around 250,000 music fans attending over 2 weekends. About 60% of attendees used Coachella's ticket payment plan to spread out the cost of their $499 general admission ticket. The plan allows festival goers to pay as little as $19.99 up front, with the balance spread over several months, typically between January and the festival. Unlike Buy Now, Pay Later services like Klarna or Affirm, Coachella requires full payment before the festival, and missing a payment means ticket cancellation. Coachella first introduced installment payment plans back in 2009, when just 18% of attendees used the option. So when I first saw this, I am a regular, or as much as I can be, Glastonbury goer. So when I first saw this, I thought this kind of makes perfect sense. And to be honest, I would have loved something like this. For Glastonbury, you pay a £50 deposit on a debit card only, and they don't let you allow a credit card. And then you have to pay the full lump sum by a specified date 4 to 6 months later, and it's very expensive. So I'm not really surprised that people want to spread out their payments. However, on further digging, the concerns come in when you look at the stats. So a 60% uptick into 2025 from 18% in 2009. And Coachella charged an 8% tariff for taking on the payment plan. So you're obviously paying above the actual ticket price in order to spread the payments. And also Coachella itself is a sort of huge status symbol event with lots of impetus on appearance, fashion, and also your accommodation choices, which equally can be paid for by Buy Now, Pay Later. People are spending over $1,000 to cover their weekend on Buy Now, Pay Later, stretching their budgets and their repayments further and further into the future beyond the payment for the concert itself. So I can definitely see why they're doing it, but the concern is whether it's sustainable long term. And this issue is only going to get worse when people are already beginning to pay for essentials with Buy Now, Pay Later, signaling longer-term concerns into the future. So for something like Coachella, I do think it makes sense, and I'm not really surprised. However, it's the direction of travel for the uptick of Buy Now, Pay Later overall that is maybe the bigger concern here, in my opinion. Now I'm going to move us on to our and finally for today, which is actually kind of a flip reverse of some stories that we do here regularly on this podcast, which is that the Nate founder was charged with fraud over AI shopping app that was secretly powered by humans. So, people getting mad that an AI product actually wasn't powered by robots after all. So this story was in FinExtra. The founder of Nate, an AI-powered shopping app, or so they said, has been charged with fraud after it was revealed that the app's checkout process was actually powered by human workers and not AI. Nate launched in 2018 and claimed that its AI could automate online shopping, raising tens of millions in funding, including a $38 million Series A round, in 2021. The app, however, did not use AI to complete transactions as promised. Instead, it relied on a team of contractors in the Philippines to manually process orders. And the former CEO, Albert Sanaga, is accused of misleading investors about the app's capabilities, falsely claiming it ran on AI and operated autonomously. He now faces charges of securities fraud and wire fraud, each carrying up to 20 years in prison after the company's collapse left investors with huge losses. Wow. Where do we want to start with this one? This is kind of the reverse of the AI hype cycle. Veronica, what's your take?
I don't even know if I have anything intelligent to say here. It's just funny. And there's two sides of this, right? Which is the story in of itself at face value. But it just I think it's such a scandal, right? I really really have no words for that. But also on the VC side is like, where was the due diligence on this? I get that AI is super exciting, but this is just it's such a gap in due diligence. Like, did you not see a product demo or something? Or I don't know. Yeah, really at a loss for words on this one, but very amused by it.
Kian, what was your take? Do you agree on that sort of due diligence point as someone who's presumably had to jump through a lot of hoops on your own round?
Yeah, it's I always find technical due diligence really interesting because I largely think it doesn't happen. And
Clearly not in this
largely you can
case.
see product yeah, you can see product demos and stuff like that. But I think it's a very difficult thing to do in some cases unless you really want to slow down the speed of fundraising, which probably you should in most cases, but things just get a bit mad. And I think Nate was timed perfectly for 2021 and stuff like that. This is like a super sad one for me because I loved Nate as a concept. We started Stitch and what were we doing, right? We were screen scraping bank accounts, right? And, we loved the concept of this was like a one-click checkout, but like, what were they doing? They were, they had your card details and you could enter any e-com website and they would scrape that website and they would enter your card details and pay, right? And we're like, shit, how do these guys do it? They just did like this at scale. We could barely do 4 banks, right? And every day our integration would break and we'd like go and we'd hack it again. And we're like, damn, that's so cool. It was like such an aspirational thing for us, like slightly adjacent to what we were doing. And we sort of couldn't work out how they were doing it. And we were like, yeah, AI or this or that. And I was just like, I don't really know how this works, but it's so cool. And I think it was one of the things where conceptually it was really cool, but the like tech kind of just wasn't there. Like I think it's really interesting now. I would love to see it both now, and I think AI is there now, but it wasn't 4 years ago. So tough. Yeah, I was like really sad to hear they shut down and then this. And so, yeah, it's quite a thing.
Sam, what was your take?
Yeah, it had a little bit of a Theranos vibe to it when you think about it. And it's one of those that, we just went through the whole, in the US, we went through this whole thing with JPMC and Frank. So where the founder's actually going to go to prison.
Yes.
I don't know if she's been sentenced yet. I should go out there and look, but she was found guilty of fraud. And same thing, right? I mean, if JPMC can't do good due diligence, what the hell? I mean, it's JPMC. They're a beast. So, we've had a couple of black eyes right now, industry-wise. This one is, I want to say it's kind of funny, to be honest, in the back end, right? Because you can just envision these people, if I was him, I would have spun it and said, hey, I'm a great employer. Look at all these people I gave jobs to. Come on, I worked on that side of it.
Yeah, I mean, yeah, there's definite parallels between both, Theranos, as you mentioned, and the Frank case. The guy looks like he could go to prison. Each charge he's up against carries 20 years, so he's probably not going to get out of it. But just the I don't know. I think it's the headline to Veronica's point that it's just kind of funny, like secretly powered by humans in a sort of AI age. It's just quite funny.
Just make sure you don't go on the cover of Forbes, everybody. The second you're on the cover of Forbes, it's over.
It's game
you're
over.
Done. Yep. The second I see you on there, dude.
Yeah,
like,
yeah.
Oh man,
you know it's over. Divest is over. Music stopping. Yeah.
Awesome. So obviously the claim here was there was AI all the way back in 2018 and there wasn't. Does anyone have a ridiculous tech claim that you've heard that turned out not to be quite what was promised? Theranos and Frank aside, that anyone can think of?
Well, other than Theranos, what about WeWork? It was supposed to be this great platform that did real estate stuff, and then it was just a real estate company. Anything that this stuff that makes like really great series and podcast series. So who knows? Maybe we'll see the Nate story come out in a highly acclaimed and awarded podcasts soon. But WeWork is definitely my favorite one because that story is absolutely wild.
Sam, any others?
I'm just laughing because how many years did I work out of a WeWork? Right?
Yes, quite.
I remember the WeWork had their own store, right, in the Flatiron district. As a matter of fact, WeWork gear. Are you kidding me? I mean, they had WeWork merch. Come on, as somebody who's wearing a Move T-shirt as we do this podcast, but yeah, they had all kind of WeWork merch. So
I thought you were supposed to steal the mugs for.
Well, yes, I guess that was the point. Yeah, it's just it is absolutely mind-boggling that this still goes on. But to the point, how good is the due diligence, right? How good are we actually doing there? Fascinating.
Yeah. And on that note, I think that's where we're going to leave it. And that wraps up this week's FinTech Insider News. Thank you so much to today's guests. Where can people find out a bit more about you and your company, starting with you, Sam?
LinkedIn. Sam Maule, Maule. Reach out. Love to talk to you.
And Move?
moov.io, not AI. moov.io, because we're cool.
Excellent. Kian?
LinkedIn's probably the best spot. Stitch Money on LinkedIn, or you can just go to our website, stitch.money, which now looks like a cool domain. We bought it 5 years ago because it cost $3 a year. So becoming sexier, and we can't afford .ai.
Fantastic. And Veronica?
Yeah, just plain old LinkedIn, Veronica Maria Gleb.
Fantastic. As for me, equally LinkedIn, Laura Watkins, or otherwise 11fs.com or this podcast. Thank you so much for listening to today's FinTech Insider. If you like what you've heard, please make sure to follow us on your favorite podcast platform of choice. And if you really like what you've heard, why not share the podcast around? And as always, if you want to join the conversation, find us on any social media platform. Just search for 11fs or FinTech Insider, or email me and the team at podcasts@11fs.com. Thanks again, and goodbye. Cybersecurity is the top concern for UK businesses, according to Vanta's recent State of Trust report. But whether you're a startup founder or an experienced security professional, Vanta is here to help. Businesses use Vanta to establish trust by automating compliance needs across over 35 frameworks, like ISO 27001 and SOC 2, centralize security workflows, complete security questionnaires up to 5 times faster, and proactively manage vendor risk. Join over 9,000 global companies like Flow Health, Synthesia, and Alica Bank, who use Vanta to manage risk and prove security in real time. For a limited time, get $1,000 off Vanta at vanta.com/insider. That's VANTA.com/insider for $1,000 off.